Good afternoon, everyone. I'm Florence from the Institute of Banking and Finance, and we are delighted that you're able to join us this afternoon for this IBF Masterclass on ESG regulation and compliance, jointly organized with ComplianceAsia. We are delighted to have with us today Mr. Joseph Chun, partner from Sook Lim and Bock LLP, who will cover a quick overview of the MAS's guidelines on environmental risk management and share methodologies and tools for assessing, monitoring, and reporting environmental risks. Ms. Philippa Allen, CEO of ComplianceAsia, will then share her insights on the impact of ESG from a compliance perspective and touch on ESG policies and procedures. Joseph and Philippa will then have a short discussion on key issues and challenges for the industry and take some questions from the audience. The audience may post your questions to the speakers at any time using the Q&A function, and we'll address them live during the Q&A session. Before I invite our speakers to share their insights, for those of you who may be unfamiliar with IBF, allow me to do a very quick intro on the IBF and the resources we have to help professionals like yourself in the financial industry. The IBF was established by the MAS in 1974 as a training provider to provide functional training for the financial industry. Since then, our role has evolved into one of standard setting for financial services sector's skills and competencies. In August 2018, our mandate was expanded to cover career advisory and jobs matching function for the financial services sector. We were also appointed as the Jobs Development Partner for the financial services sector last year by the Jobs Development Council, and now oversee both jobs and skills development for the financial industry in Singapore. Here's a quick look at our services and how we support the industry across training, recruitment, and workforce transformation. You can find out more about our services and connect with us on any of these areas via our website. We have also put in place enhanced training support for the financial industry to further alleviate training costs during this period. The enhanced course fee subsidies are part of MAS's support package to sustain and strengthen capabilities in the Singapore financial services and fintech sectors amid the current economic downturn. The aim of the enhanced training support is to encourage more companies to send their employees for training and upskilling so that they are in a better position to help the company move forward when economic activity normalizes. Funding support has been raised for training to 95% across the board for all FTS and IBF STS programs until the end of June this year, subject to prevailing grant caps. The funding quantum will be reduced to 90% after June before going back down to pre-crisis levels in 2022. You can find out more details on the enhanced training support on our website. Apart from the increase in course fee subsidies for programs this year, training allowance of $10 per hour for self-sponsored trainees and $15 per hour for company-sponsored trainees will also be given for training undertaken. You can find the list of eligible training programs on the IBF Program Finder on our website. In addition, the IBF will also be supplementing the commercial training available with free webinars like this one during this period to support the training needs of the industry. Financial professionals can also tap on the Learn at IBF mobile learning app for bite-sized learning at your own leisure. All these complimentary training are quoted with CPD hours. And that concludes my very short intro. I'll now hand the time over to Joseph, who will share more on the regulation of financial sector environmental risk management.
Hi, everyone. Thanks, Florence, for the very kind introduction. Hi, everyone. I'm Joseph, and I would like to just give me a minute to share the screen. So this afternoon, I'd like to give you an overview about the regulation of financial institution environmental risk management. What I'll do is to first introduce to you the concept of environmental risk, and then take you through the sort of big picture developments leading to the MAS issuance of the guidance or the expectations on how FIs should manage the environmental risks. And then I'll sort of conclude by looking at some of the sort of possible tools at the MAS disposal to sort of enforce these expectations. So a little bit about myself. I'm a partner at the Sook Lim & Bock LLP, and I am actually an environmental lawyer. I spend sort of part of my time at the firm, but also part of my time teaching environmental law at NUS, covering the gamut of environmental law sort of regulations. And in particular, in Julian and Bock, I focus on the environmental advice, compliance issues, and on the regulation. But I also support my colleagues who in the corporate and in the banking, the practices when they have environmental issues, or when they're looking at certain particular issues that crop up in the course of due diligence or in the course of transactions. So what is sustainable finance? I'm not sure about the level of familiarity in the audience. So I'll just quickly mention that sustainable finance is really about understanding the alignment or the contribution of regular finance and financial activities with sustainability and sustainability metrics, and in particular sustainability as understood in the business world these days. It is environmental, social, and governance issues. Okay, and so today we are really going to focus on the environmental issues, and in particular climate change mitigation. So why the sudden interest in ESG, in particular the environment? Well, there has been a lot of growth in opportunities, but also a lot of improvement or acquisition of the knowledge about the environmental risk, especially as the risks have been growing in the last few decades. Opportunities are that you have a lot of investors now who are very interested in investing in producing green outcomes, or at least to reduce their environmental risks. It's not only the investors, employees, especially the millennials, are also very sort of conscious about the employer that they work for, what is their purpose, what is the environmental impact, and so on. It's the same for customers. And there's some empirical evidence to suggest that investment in high ESG performing companies actually brings positive financial returns. But this is all contextual, so it's hard to say as a blanket rule that ESG investment all sort of bring better returns than non-ESG investments. On the risk side, there's a greater sort of appreciation of the risks. Legal risks has always been there, but litigation on environmental issues against governments as well as businesses have been stepping up around the world, particularly in the US, in Australia, and in Europe. Even in Asia, you have now got climate litigation cases being brought in South Korea and in Japan. Not so explicitly in Southeast Asia, although it may take a less sort of a more subtle form. Reputational risks are becoming important, again, because I think there's greater access to information, and people are more capable of sharing information that they find online. The two sort of main risks that are very sort of pertinent to environmental issues are the physical risk and the transition risk. I'll take you through what these are. Physical risk, I think, is quite obvious that with increasing extreme weather events, there's going to be greater physical damage and physical disruption to business operations. Also, it's not only just the climate change related physical risk, there's also biodiversity loss, things like deforestation leading to losses of sources of raw materials, depending on the business you run. Transition risk is also something that of late businesses in the last few, I suppose in the last decade or so, have been thinking a lot about as the world plans or starts to move towards Paris compliant world, i.e. trying to keep global warming to less than 2 degrees, or even pursuing 1.5 degree cap above pre-industrial levels of warming. There is an understanding that society has to start reducing and eventually reaching net zero their carbon emissions. So what does this mean for businesses? It means that there will be a risk that if you are still operating your business as you are sort of pre-Paris Agreement, then there's a risk that you may find consumer preferences changing. You may find technology accelerating towards low carbon sort of methods of doing business. You may find governments passing stricter and stricter standards. All these are going to impact your businesses. And how will all these things affect banks and other financial institutions? Well, you are going to these businesses that are affected are going to be your lenders, borrowers. They are going to be your customers who are going to you are going to invest in. They are going to be people who will be buying insurance policies from you. Another sort of risks that is a second order, if you like, second order risk is that with all these risks, legal risks, reputational risk, physical risk, and transition risks, your business counterparty credit worthiness may also be affected. So that's going to ultimately affect you as the financial institution in the second wave of impacts. So a bit more on environmental risk. If you look at the TCFD publications, TCFD stands for the Task Force on Climate-Related Financial Disclosures. I will sort of say more about the TCFD at the end of my presentation. But if you look at an example of what physical risks are, and this is an example just focusing on climate-related physical risks. You're going to have extreme weather. You're going to have changes in precipitation. You're going to have rising mean temperature. You're going to have rising sea levels. And all these things will play out. In fact, they are already playing out. It's not something that will happen in 50 years' time or something like that. It's already playing out, and it's only going to worsen. The thing is, it's going to happen, but in what magnitude and where and how is something that is still being sort of worked out. And all this is going to have an impact on revenue due to disruption from your supply chain, affecting your productivity of your workforce due to absenteeism and so on. There will be write-offs of assets that are damaged. There will be increased operating costs if you find yourself running out of water. Capital costs may be incurred to repair facilities. Reduced revenues due to changes in the physical sort of conditions, and then there will be increased insurance premiums. For insurers, there may be increased payouts. Transition risks, as I mentioned, is changes due to sort of advancements in policies and legal standards in response to the need to get society and the world at large towards net zero. The IPCC, International Panel on Climate Change, which is a scientific body, projects that to get to our target of well below 2 degrees Celsius of warming, we as a world, globally, we have to reach net zero carbon emissions by 2050. Okay, so this means that if we want to avoid the worst excesses of climate change, we are all going to have to, one way or another, invest in low carbon emissions, invest in, I suppose, carbon sequestration, invest in nature-based solutions. And all this is going to mean that they will have serious impacts on the way business is currently done. They will have serious impacts on the returns of your current assets. And if you're not careful, also your future investments, if you're not taking into account of these risks. Okay. So apart from the policy and legal changes and technological changes, there's also going to be market changes as consumers change their behavior, and the cost of raw materials start to rise due to disruptions. Reputation is also a transition risk as consumer preferences change. Certain sectors, I don't know if you've been following the news, but certain sectors have already been stigmatized. There's a lot of divestment campaigns going on. They get sued. All these sort of contribute to the reputational risks. And here's another organization, the NGFS, Network for Greening the Financial System. I will say more about it in a while. The NGFS has suggested that all these risks, physical risk and transition risk, are going to affect businesses individually, households individually, but in aggregation, they are going to affect the macroeconomy. And all these risks, as they materialize, are going to transmit into financial risks and therefore affect the financial institutions in the form of credit risk, market risk, underwriting risk, operational risk, and liquidity risk. So what is the regulator's concern then? It is about, of course, there are a couple of, there are two objectives mainly. One is to try to advance the green finance growth opportunities. But today we're going to focus really more on the environmental risk management, how to ensure the stability of the financial system and financial institutions within the system. So this risk, the problem of environmental risk transmitting to financial risk was sort of highlighted as early as 2015. Mark Carney, the then Bank of England governor, in a speech to Lloyd's, at Lloyd's, spoke about how the environmental risks, the looming environmental risks, are going to translate or transmit into financial risks. There will be physical risk as well as transition risk, leading to stranded assets, leading to possible financial collapse if we don't do anything about to sort of prepare for the risk. Mark Carney also chaired at the time the Financial Stability Board, which is a international organization set up by the G20, and the and so here's where I talk about the TCFD. Yeah? So the Financial Stability Board set up this TCFD, Task Force on Climate-Related Financial Disclosures, to make recommendations on how to get businesses, including financial institutions, to disclose their basically not only the climate-related risk, but also their strategies and management approaches to address these climate risks. And so the TCFD was set up in 2015, and in 2017 they made their recommendations. So these are known as the TCFD recommendations, and they relate to financial disclosures. NGFS, I mentioned earlier, the Network for Greening the Financial System, is a club of central banks, and they were set up in 2017, and because of the awareness that there's this looming environmental risk that all central banks should be concerned about, and then what should central banks do to address these risks. And so the NGFS was set up in 2017. MAS is one of the founding members of this NGFS, and the network has over a period of years published a number of publications and recommendations. Of course, they have no binding force, but they're all purely voluntary, but it's for central bankers to take note of and then implement as appropriate to their particular jurisdiction. So they come up with a number of publications. These are some of them. I will actually be referring to some of the recommendations or information from these publications later. Okay, and one of the sort of to set the tone or the context, the NGFS sort of did a survey of its members to find out what the expectations were in terms of managing environmental risks by financial institutions. And so the expectations, some of the expectations were on governance, right? There must be clear definition and allocation of responsibilities, etc. There must be an articulation of the strategy in play to take into consideration the looming environmental risks. The use of scenario planning was sort of highlighted, stress tests and scenario planning. Risk management, having in place processes to identify, assess, monitor, and then manage this risk and develop metrics to measure performance. was also highlighted as an expectation. And lastly, the importance of disclosure on how you are sort of planning to address this risk was highlighted as something very important. Disclosure in a common format, whether it's global or regional format, in particular the TCFD recommendations. And so following from that recommendations, a number of central bankers started to take action, such as the UK PRA, Prudential Regulation Authority. In Europe, the European Central Bank has also issued its guidance on environmental risk management and disclosure. Singapore is no exception. Remember, Singapore is the founding member of NGFS, and they have also highlighted the importance of addressing climate change and other environmental risks. And they have also, apart from trying to develop the green finance markets, taken out a number of measures to build resilience in the form of guidelines, right? Setting out expectations, and then through the Green Finance Industry Task Force, which is private sector driven, develop implementation guidelines also to look into developing a taxonomy for what's green and what's not. So I encourage you to read the guidelines themselves. There are separate guidelines for banks, for asset managers, and for insurers, and then also read the ABS on the ABS website. But it is the implementation handbook published by the Green Finance Industry Task Force. What are the FIs covered in these expectations or guidance? Is the banks, is the asset managers, in particular the licensed fund managers, the REITs and the registered fund management companies, and the insurers. These are some of the environmental risks highlighted in the guidances and how they translate into financial impacts. I covered this kind of under the NGFS publications. Similar to what the NGFS has suggested, supervisors are expecting, MAS expects the board and senior management to define clearly their roles, respective roles in how they are going to manage environmental risk. So for the board, it is approving the environmental risk management framework and policies which are developed by the senior management, and then ensuring that these risks are addressed in the risk appetite framework, setting clear roles, having an adequate understanding, and having sufficient expertise to understand these risks. Senior management will need to develop the framework, review the effectiveness of the framework, and establish internal escalation processes of environmental risk, keep the board updated on the risk issues, and then allocate adequate resources to manage this risk. Risk management sort of framework, policies, and processes have to be put in place. So everybody's clear. This is functional as well as across the along the business lines. So everybody's clear what their role is. There has to be identification and assessment of this risk on a customer and portfolio basis. And apart from identifying the risks, there has to be processes for managing it and monitoring it. There will also need to be a way to identify the high-risk sectors and then developing sector-specific policies for to address these risks. One of the sort of important tools for risk management is the development of scenario analysis and stress testing capabilities to look at short, medium, and long-term scenarios or sort of events. And then, of course, lastly is the capacity building that involves the training. It's up from the board down to the rank and file and the management and operational people. They all need to know what their role is and then how to perform that role. For asset managers and also for, I suppose, insurers in their investment function, there's a need to monitor the investments they make, and where for particularly high sort of risks investments, there is an expectation that there will be engagement of the investees, or if in the case of investors like insurers, they need to engage their asset managers, and then the engagement process needs to be documented to encourage disclosure and also to understand how they are managing these risks. For insurers, to address underwriting risk, there's a need to identify and assess the environmental risk for each customer as well as across the portfolio, and then where necessary, the transactions with higher risk have to be escalated to the risk management committees, and quantitative and qualitative tools and metrics will have to be developed to monitor and assess these risks. Lastly, on disclosure, disclosure should be on an annual basis, at least on an annual basis, and they should disclose the potential impact of the risk, and disclosure should be in accordance with well-regarded frameworks like the TCFD recommendations. So the TCFD recommendations are sort of built on 4 pillars, and you can see that they've actually follow closely the sort of expectations of MAS and other central banks. Firstly, there needs to be a disclosure on the governance, right? Who is in charge of what? What is the bank's board overseeing? What is the senior management doing? What is the strategy for addressing climate change? How is this impacted by the foreseeable as well as expected sort of risks that are looming? What are the processes for addressing these risks, right? And finally, what are the metrics and targets that are being used to measure risks as well as to measure performance in management? Okay. The implementation timeline is that MAS expects that, first of all, MAS expects that implementation will not be uniform. Different FIs have different sizes, activities, and so on. So their response is going to vary, and also given different capabilities and different starting points. But the timeline is 18 months from December 2020 when the guidelines were first formalized and issued. And MAS says it will start engaging with larger FIs from next quarter. Okay. The methodologies will also sort of mature. All that's being developed. So this implementation is going to be dynamic. It's going to evolve over a period of time. The next steps, I just wanted to share with you that NGFS also suggested some of the things that central bankers can look into to, I suppose, take more action apart from expectations, issuing expectations. So these are, for example, where it finds a financial institution lagging behind in its environmental risk management or in its disclosure, then the first sort of step is to discuss these findings with the board, the board of the FI concerned, and requiring adequate follow-up. And then at the next level, to require FIs to strengthen risk management and internal control systems. Then sort of going at the next level, there may be a need to require FIs to integrate the risk as they are transmitted into financial risk into capital adequacy assessments. This is also something that is discussed in the UK and European sort of central banks expectations. The FIs should consider whether there's a need to increase capital reserves to address these risks. And then there may be a requirement for FIs to reduce the level of risks, right? And ultimately there may be enforced limitations. And then sort of going down the sort of severity, ultimately there may be a need to require policymakers and lawmakers to modify the regulations for capital requirements. So just a possible steps. It's not the case that all central banks will be doing it. It's just something for the central bank, the members as well as non-members to consider. Okay, so I'm gonna finish here and then look forward to your questions. Thank you.
Thank you so much, Joseph. Thanks very much. We'll now invite Philippa to come on and share more on ESG policy implementation. Yes.
Great, thank you very much. For those of you who aren't sure about ComplianceAsia, I'm the founder of ComplianceAsia, and we are headquartered here in Singapore, and we have offices also in Hong Kong, Shanghai, Japan, and London. And our newest company that we launched here in Singapore, which is ComplianceAsia ESG Consulting. So this is a very timely seminar for us to be participating with the IBF in. Can I just confirm, Florence, that you can see my screen properly?
Yes, it's great.
Great. So I've been looking at this issue for a number of our clients for some time, primarily because the current ESG drivers that are around there prior to regulators jumping on the bandwagon somewhat has been driven by investors and shareholders. So the 2006 was when the UN first issued its Principles for Responsible Investment. Originally 63 investment companies had signed up for it. By 2018, there's nearly 2,000 signatories and a massive increase, as you can see here, in the amount of global AUM that represents. Now, that's both investors in funds, obviously, but also investors in some of the institutions that you will be working for. The asset owners globally, be they pension funds or endowment funds, large sovereign wealth funds, etc., are reporting by 2018 to FTS Russell that more than half of them have some ESG overlay in their investment strategy. By 2020, 85% of hedge funds are reporting that institutional investors are their biggest drivers of demand for ESG products. And in the world of private equity and venture capital, increasingly important in Asia, the LPs are driving a lot of these considerations. The figures can be seen in the report that was issued by the Global Sustainable Investment Alliance in 2018. Now, there's clearly some variation with Europe and Canada in particular, Australia all being the largest drivers of this, with the United States lagging surprisingly somewhat behind, and Japan and Asia being minuscule by comparison from sort of 2014, 2016, but increasing rapidly since then. Looking at the growth of sustainable investment strategies, again, you've seen a similarly large increase over that period of time. So this information is taken, as I said, from the Sustainable Alliance report that they issued. They're due to issue another update shortly. So what have we seen typically as the most common ESG options or sort of strategies that people have adopted? They've either become signatories to the PNRI, the Principles for Responsible Investment, or the PSI, which is the Principles for Insurance and Banking. And there is a risk, of course, for these that some people just put the sort of logo on their website and sign up and they're not properly implementing them. There are ways that you can show that you're in compliance. There's requirements, for example, to show improvement in your approach to the PRI. And you're supposed to have those, your progress each year reviewed either internally or potentially by an external vendor, just to be able to demonstrate that you are in compliance. Some of the bigger global firms, particularly in the asset management space, have come up with customized ESG frameworks based on internal models. So Robeco Sustainability Asset Management product, for example, is very famous in the asset management universe, but groups like BlackRock have also taken very distinct and leading positions in relation to ESG. The adoption of the TCFD reporting, as indicated by Joseph earlier, or similar models, and there's quite a few of them, unfortunately, for larger global firms who are already adhering to these sorts of principles. You also see, particularly in this part of the world, a comply or explain approach. There is definitely alternative strategies where it is difficult to develop an ESG overlay. It's not impossible, but it's difficult. And so in many cases, particularly hedge funds have explained why it's not relevant to the investment returns that they're trying to deliver. So these are some of the questions that I'm asked by the compliance officers and legal people that we deal with internally. Where do I go? Where can I find help? Some of the references here have already been mentioned by Joseph. I would point out as well, there's a couple of other things out there. There's the Green Taxonomy and the relevant standards for Singapore and ASEAN, the consultation that's at the moment. The UN Principles for Responsible Investment are very helpful. We will look at those later on. There is also on the banking side, the Central Bank and Supervisors Network for greening the financial system. In Asia, if you're sitting here as part of a bigger organization, you're probably having to look at what's going on in other jurisdictions as well. And it's certainly relevant that in Hong Kong at the moment, the SFC has a consultation paper, which is very specifically focused on climate fund risks, climate-related risks for fund managers. It is proving controversial. It's very prescriptive and has a great deal of detail in it. And many of the fund managers who will be in scope in Hong Kong feel that it is out of line with what is happening globally, in that, you know, there's usually for the large international managers, they're working at a global level, not a local level. There's also the existing stewardship codes throughout Asia, the most prominent ones being the Singapore, Japan, and Hong Kong principles of responsible ownership, or for responsible investors, which have been taken into consideration now for some number of years. If you look at reporting information, this is where it gets a little bit more confusing. There's a lot of different reporting standards and different reporting methodologies. There is a current attempt that came out of Davos in July last year to develop a common set of metrics and reporting disclosures. The International Business Council has support now from most of the big four, the guys who are going to have to do the auditing around this sort of work, and other big and important asset management, big and important audit firms globally, which is very positive. But if you look at this, there is a number of other standards that conceivably either firms within your group of companies or investors are asking you to look at. And this certainly does make it complicated when you're looking at the stage of moving towards reporting. As I said, the page does continue. There's quite a few specialist types of reporting that we see as well come out, particularly if you're looking at, for example, oil and gas investment, or if you have German funds where the German Council for Sustainable Development is relevant. Without wanting to sound gloomy about this, the next question we often get asked is, how hard is it to achieve ESG? The issue is it's quite hard. So talking to firms that do ESG implementation, because it's not just about reporting, it's more difficult to move straight from the stage of we're going to not have an ESG policy and now we're going to be reporting on our ESG activities. There's a long development there in the process. I know the MS has given 18 months in this consultation paper. However, there are indications that for some of the larger firms, the process or the journey towards full ESG integration has taken up to 5 years. So it's not an easy thing to do or to do quickly. And certainly in this case, what we're telling our client base is that clients and the MAS are not looking for, nor are the investors or their clients, looking for just a kind of cut and paste style of approach to this. They really are looking for something that is customized and relevant to you. So are people struggling? Yes. Now I've pulled together a few different pieces of data here. I know not everybody's a hedge fund, but I think this sort of information will show problems that are being experienced by other parts of the industry as well. The lack of sustainability data is particularly relevant in Asia. There is problems in many of the markets with getting reported information from the listed companies themselves. And there's certainly concerns from the asset manager and asset owner universe that the focus being made for them to achieve ESG standards has somewhat taken away from the what should be the correct focus, which is on making the listed companies more meaningfully report this information, not just the large companies, but all the way down through into the second boards and into the minor stock exchanges in Asia as well. So what are some of the difficulties that have been highlighted? Climate-related disclosures are in an early stage of implementation. So it's hard to find companies that have a degree of sophistication in relation to climate change reporting, and is skewed because it's much more mature in the large cap than the mid cap or small cap companies. That is very applicable in this part of the world where there are a number of emerging markets or developing markets that are in main indices, but don't necessarily have that maturity in their large cap space. Often companies will say that they have climate related policies, but they don't talk about how they actually monitor those policies and manage the risks. There's not enough explanation of their resilience to climate risk. So this point is being taken up in the US, where there's some work being done around making clients price, or analysts rather, price into the share price of the company or predicted share price of the company the degree of their exposure to climate risk. There's insufficient articulation of the theme areas that Joseph mentioned earlier. Insufficient descriptions of the board oversight, or how much the board is really committed to environmental transformation. Again, the listed companies themselves are sort of being accused of a bit of a cut and paste solution here. There is problems as well with the metrics, but they're not being linked to targets and risks. And the reporting practices that asset owners and asset managers report that they would like to see improved, more specific, not just general information, and disclosure that actually have supporting and underlying information behind it. There are also problems in relation to the fact that users are very keen to have sort of quantitative information that preparers, the listed companies themselves, are not always comfortable about disclosure or disclosing. And there are challenges in various scenario analysis and scenario models that the end users of this reported information are increasingly highlighting. And there are shortfalls of the extent to which the companies will actually sit down and look at the quantitative impact of climate change risk on their financial metrics. So what do these companies themselves, the listed companies, think the impact of climate change risk is going to be on their future performance? Now, that makes it very difficult for asset owners and asset managers and banks to be able to deal with their own regulatory requirements, which have now been overlaid on top of the investor-driven importance of ESG. If you look at 2020, where again the Global Sustainable Investment Alliance conducted a poll, it included 84 large asset managers and some service providers. So only 16% of respondents were reporting fully in accordance with TCFD by 2019, with a further 20% or so intending to do so in 2020, and about another 30% exploring the possibility. The UK reported the highest compliance, with Europe and Australasia, which was primarily Australia and Japan, either being in the planning or exploring the possibility stages. The US reported a relatively low level of consideration of reporting in line with TFCD. What this means is that the largest firms are finding it tricky to achieve full compliance, and it is something to consider when looking at your own obligations that are emerging in Asia as potentially smaller firms. You're not out of scope of what is the experience being globally, that it is a difficult thing to achieve. It does need resource, it needs specialist assistance, you need good data, you need to have the ability to be able to plug into the right information. So it's very important that is communicated back to management, that in order to start achieving these sorts of degrees of compliance, you do need to have proper sort of resource, and that's in terms of the ability to purchase information, to have internal resources, internal staff training, and also to be hiring experts either internally or externally. So again, you can see some of the figures here. It's interesting that Japan is sort of during 2019 was reporting that there weren't plans to engage in full ESG reporting. We're now hearing that number is actually falling. The Japanese government has become quite keen that the amount of ESG reporting is improved. So it may be slightly old information given where we've got to in 2021, as opposed to 2019 when we had the survey. So just as well, the other thing that's relevant in this part of the world for many of, certainly on the asset management space, but also in relation to distribution activities, insurance wrappers and the like, is that there's an awful lot of fund level ESG regulation. The EU in particular, where many of the funds that are sold in Singapore and indeed in Hong Kong and elsewhere in Asia are based, have a large number of fund level ESG rules that are in the process of coming into effect or have just come into effect. So for example, from March this year, large asset managers, both EU and non-EU, need to publish their due diligence policies in respect of the principal adverse impacts of investment decisions. So they're going to have to be integrating sustainability risk into their investment decision-making process more thoroughly. And spending a lot more time disclosing ESG policies and the ESG profile of funds. You're going to need to be making something called an adverse impact statement. Similarly, the taxonomy regulation, one of the heated global debates about what is the global standard. Certainly the EU taxonomy is very advanced. It's a phased implementation, as was the previous regulation. And again, that imposes supplemental disclosure obligations on fund managers at the fund level in relation to ESG, and will lead to updated documentation and periodic reports and so on. The final issue is this, what's called the Level 2 Delegated Acts re-sustainability risks. And this means that you need to ensure that even alternative asset managers, so that's incorporates both the long-only traditional sort of UCITS funds and more alternative funds, that they're integrating investment decision and sustainability factors into their operating risk management product governance processes. So there is not just the new changes that are coming out for you as potentially as advisors or managers and distributors of funds, or indeed as asset owners, but also stuff that's happening at the fund level itself. The UK is working on governance of climate decision making. This will be first applying in 2022, relevant for those of you who operate, as part of a group that has a UK operation, or potentially with the UK head office. And finally, you've got this sort of slightly odd problem that's emerged out of the US for certain large international investors, where the Department of Labour, in respect of what are known as ERISA funds, which are basically employee retirement schemes run by various government agencies, state level governments and so on, fiduciaries, i.e. the managers and the advisors, can't subordinate returns in favour of non-pecuniary goals. It's been called an anti-ESG provision. It's not really the case. They're just saying that, they need that if you are looking at making an investment on behalf of an ERISA plan, the more relevant consideration is the risk-adjusted economic value of the particular investment, and not trying to achieve some other societal or governance-related achievement through making that investment. So what do you need to be doing at this stage in the life cycle of where we are with the MS and its consultation, as well as the various other consultations you may be looking at in the region? It's a good idea, I think, to do an ESG kind of like snapshot assessment. It's not exactly a gap analysis, but if you're looking at the sorts of where you're at now questions. So dividing it up into various areas. So in governance, for example, is there evidence, is the board and senior management actually exercising oversight of how you manage climate risk and environmental risk? Do the roles and responsibilities of your board cover those? Is there a regular reporting schedule where ESG and environmental matters are raised to board level? Is there specific board and senior management training on ESG? In strategic planning and business plans, so at both the strategic level, but also at the business unit level, when you're looking at new customer segments, when you're potentially looking at new products or services, expanding business lines and so on, are you looking to incorporate environmental risks into that? An example that is coming up quite frequently at the moment is people who want to make crypto investments, who are considering the ESG problems that go with mining, and the power that's generated, the amount of electricity that's required to sustain mining that may be going on in certain types of cryptocurrencies, for example. Have you got anything yet? Are there any written ESG statements, policies, or procedures? Is there something floating around that's being produced? Have you put the UNPRI logo on your website? What has been said to date? Are you considering financial planning at this point? Have you looked at how to incorporate climate risks and environmental risks into your own financial processes, your operating costs, capital expenditures, acquisitions, and so on? Are you actually doing scenario analysis? So are you sort of future-proofing? Are you looking at the physical transition risks and broader environmental risks that exist, and assessing the impact of those in relation to, I don't know, your business operations, your loans portfolios or investment portfolios, and your planning process for your future development. Are you doing environmental and climate risk analysis as part of your stress testing exercises that you do? Risk management, very important area to be considering as well. You need to be looking at both at a corporate level, but depending on the nature of your business, also at a business level. So if you are engaged in the lending business, for example, if you're engaged in the asset management business, if you're a private equity manager, what sort of risks are subsisting within the portfolios that you're managing or within the books of business that you have, but also what risks are posed to you as an institution and your future survival in relation to these types of risks. So for example, if you're looking at the types of questions you could be asking your risks team and where they're at, does credit assessment take climate risk into account? Are there limits or restrictions in lending into sectors that are prone to climate or environmental risk? Does the investment policy have any specific reference to climate risk? Are you setting targets in relation to managing climate risk? Climate risk. Are you trying to enhance your staff capacity? You're trying to develop that skill set so that you have the right people on board. Does the data management framework in terms of your management reporting system, is there anything that is being produced that is helping to identify or control climate and broader environmental risks? Now, you certainly see this in specialist groups, certainly in very specialist asset owner and asset management institutions. There is a lot of this that is in existence, but if you're new to this field, it's important to know what is there. When you're looking at investing methodologies, again, these are terms that are sort of floating around quite a lot. There's a variety of different ways that we're seeing people deal with this at the moment. So you have negative and exclusionary based screening. That actually has existed for some time in relation to funds that were supposed to be socially responsible, for example, or Sharia funds. So there's certain types of activity that can be done at that level. This is also a type of screening that will be done by certain of the asset managers that we deal with, for example, that have more macro style of investment, where they're not looking necessarily at individual stocks and individual companies, but they may be looking at investment in currency or at a sovereign level, and they can work through the countries that score lowly on the ESG scores. There's norms-based screening, where you take some of the 10 principles or some of the other types of public and industry-wide sets of guidance on this area, and if you are violating those norms, excluding those. There's perhaps slightly more positive, and these three screenings are often combined, where you see a positive or best-in-class screening, so you actually deliberately choose companies to invest into with strong ESG performance. Sustainability-themed investing, and then as you get towards the more complicated end of it, because it does require a lot of work in relation to how it's implemented into your investment process, ESG integration, where you start to actually consider ESG at a fundamental level in your relation to your entire investment universe. Active ownership, fairly specialist sort of investment strategy, where you're engaging with the portfolio companies to try and turn them around, and that might include ESG. And then impact investing, where you're trying to actually make a positive statement or positive impact on an ESG issue. So ESG incorporation is looked at in a variety of different ways, and these next few slides have information that I've extracted from the UN Principles of Responsible Investment. They have a investor section you can go into, and it gives you guidance at a fairly high level about some of these things. If you are a compliance officer or a control function, legal, and you're not involved in ESG day to day, and that this sort of thing is new to you, I recommend it highly as a great place to start, because it explains in very simple English, and very sensible sort of normal terms, the types of ESG issues that otherwise may be being dealt with by your specialist ESG team or your specialist ESG, investment officers and so on. So they compare what you do in relation to ESG incorporation versus sort of active stewardship or active ownership. And so ESG incorporation is when you're looking at, eliminating those types of funds as firms to invest into, which have the sort of negative, as I referred to in the previous slide, the sort of negative or exclusionary screening, through to the more active end of it, where you'll be engaging with those companies, or perhaps formally disapproving on or approving special ESG issues through the proxy voting system. There's a little bit more detail here about the types of screening that you might want to see. For example, you've got in negative screening, avoidance of, alcohol, tobacco, gambling, adult entertainment, military weapons, fossil fuels, and nuclear energy. That is a relatively common set of investment restrictions that are now handed out by certain types of asset owners and asset allocators. Sharia screening, as we indicated, is a subset of this. Or people potentially looking at a materiality threshold, where you may be only able to invest up to 5% in a sort of negatively screened business area. Norms-based, we mentioned some of the UN treaties, Security Council, the Human Rights Declaration, OECD guidelines, the kind of countries that are potentially failing at the various climate protocols or at the UN International Labour Standards and so on. And then positive screening, as we mentioned, is looking at the more active inclusion of better performing ESG companies. So how does it work if you're looking more at the private equity world? The private equity firm will typically screen deals during the early stages, because obviously as part of the due diligence, you want to make sure that there's nothing that's going to come up that would just stop the investment altogether. What we're seeing nowadays is sometimes the GP is leading the screening, but more often the LPs themselves are applying their own screen. So they're looking about whether they want to go into a deal or opt out of a deal. You then sort of continue through the due diligence process and look at whether there's ways to increase the company value through ESG initiatives. So that once you've invested, you then get to the stage with the portfolio company where you're going through items like giving them an ESG policy, making the portfolio company's board accountable for ESG, organizing distribution of information about ESG topics. And what this is doing is bringing ESG criteria away from just being a matter for listed companies in the listed sort of stock exchange traded universe, and helping to start to move ESG into the private investment world. So it seemed to be a very positive development in relation to broader adherence to ESG standards, because obviously it would be far too easy to simply think, well, I'll set up a company and I'll run it as I want and I'll never have public investors, and it won't matter that it breaches all sorts of ESG principles. You then, obviously the GP can monitor the portfolio company and continue to hold the portfolio company to account, if you like, in relation to their achievement of ESG goals. And the sort of selling hook, I suppose, is that you can say to these private companies that when the deal is exited, that having this type of responsible investment approach will bring benefits, that if they can demonstrate that they've adhered to ESG standards throughout the process of moving from being private to being perhaps acquired or perhaps listed, that they're going to get a better value. And so it helps bring it home to the founders. There are harder strategies. There is definitely concern, for example, if you look at sovereign debt. There's fears that ESG engagement could be seen to be political criticism, and that is certainly a fear that is happening in some parts of Asia at the moment. The question of size comes up in some sorts of strategies, including sovereign debt. I mean, if you don't have a huge amount of holding, then you don't really have the weight to bring it to be effective. And there's a sort of fear that you don't need to worry about it if you're only investing in developed markets, because really it's only in sort of emerging markets that you can identify sovereign ESG risks, which is not really true, but there are sort of constraints in these types of areas. So you definitely see pushback, people saying it's not necessarily going to be effective or we can't do it. And the UN makes the point that there are engagement benefits that can be achieved, both for the sovereigns and for investors, in looking at these sorts of issues in the world of sovereign debt. Likewise, we've just assisted a client, which is a quantitative client that invests solely in currency-based derivatives, but we have looked at some ways in which they are able to demonstrate their ESG consideration in their investment universe. They can eliminate certain countries, but also looking at ways that they can adopt more active ESG policies and operating methodologies within their own business. So looking at how they're handling their own climate exposure, looking at the use of carbon credits and so on. So there's definitely things that can be done that may be work at a corporate level, not just at what you're investing into or who your clients are. I certainly think the banks have been better at that than some of the asset managers have. So that brings me to the end of my presentation as well, Florence, which means that I think we're now at the time for some Q&A, if there are any that come in.
Yes, thank you so much. I think while the audience mull on what has just been shared, I'll invite Joseph to come back on, and perhaps we can discuss some of the few topical issues while we wait for questions to come in from the Q&A from the audience. Audience, you are invited to post any questions you might have to the speakers using the Q&A button on the bottom of your navigation bar, and we'll read them out and have them addressed live.
Excellent. So Joseph, perhaps just between the two of us, we can sort of chat a little bit. I think that the MAS timeline of 18 months is certainly better than what we saw proposed in Hong Kong, which is a much shorter timeline. But it's interesting when you sort of talk about some of the experiences of people where it's taken them several years to move into operating in a way that sort of complies with the UN principles, for example, or some of the other standards. What is your sort of experience in that area? That it's, what's the kind of journey towards ESG like?
I think for the big banks, I think you can see that they have already started taking steps. But I think I understand that for asset managers, they come in many different sizes. So some of them have not even started looking at this, so they will need time. Data is something that is still very lacking. Good, reliable data. Methodologies are still evolving. So I mean, I assume 18 months is indicative because lots can happen between now and 18 months time. MAS may then say, looking at how everybody's progressing, we can either bring forward the implementation deadline or push it back, but more likely the latter than the former, right? So I think the 18 months is probably just a sort of something to work towards, and it's not going to be the same for everybody because as I mentioned, the sort of capability at this point is quite uneven. So yeah,
exactly.
Yeah, I think
I can see we have one question. So how are asset managers handling the conflicting taxonomy regulatory guidelines when they operate in multiple jurisdictions? I think what you're seeing is that certainly from my experience with it, the EU has definitely got the most developed methodologies around this currently. And so most of the firms, if they have an EU exposure, are defaulting to the EU position. And certainly the MAS recognises that in the specific guidelines for asset managers here, where it says if you have global standards and global policies and procedures, make sure that Singapore is included in that, but they're not attempting to kind of reinvent the wheel. I think that's the intent of their, frankly, very sensible guidelines. There will always be individual conflicts that are sort of potentially the specific fund, investment restriction, investment universe, mandate sort of level. But I think, as I said, the default is to look to the highest standard and incorporate that, and sort of have a representative here who is the kind of voice, if you like, of the ESG process for Singapore, but as part of the global group. Joseph, the next one, I think you can see it as well, like who's the right person to, if you don't have a dedicated environmental sort of or ESG senior officer, where does this responsibility sit?
I think the MAS is expecting that there will either be a person or a committee who will assume that responsibility. So that is the expectation. So if you don't have one, then I think you have to start thinking about having that structure where somebody is or a committee is responsible for that.
I agree.
Yeah, and on the sort of taxonomy point, I think that's a real problem. when it comes to regulatory guidelines, I think it's relatively easy to say adopt the strict, more stringent one. But when it comes to taxonomy, it's going to be quite challenging, because I think the indication from our GFIT, Green Finance Industry Task Force, is that they're looking along the lines of trying to tailor something that suits ASEAN's evolving needs, in terms of, so I suspect that, but they're also very mindful of the need for harmonization. And in fact, indeed, the UK, for example, and in Europe, they are looking at this. They have this thing called the International Platform on Sustainable Finance to try and harmonize standards. China has its own taxonomy and so on. And they are all working towards harmonizing. Harmonizing doesn't mean having the same taxonomy, but at least having taxonomies that are compatible. So I think one of the comments I've made to the in the consultation on GFIT is that yes, it's right to consider ASEAN social Southeast Asia's needs, but you are going to have a problem if you're trying to, investors will have a problem if you're trying to report across different jurisdictions, because they have to report to the EU on their investments in Southeast Asia as well. If the asset manager, for example, is based in the EU, it's going to be very problematic. So
someone's asked a question saying, is the MAS's focus for investment firms to manage their environmental risks or to invest in ESG? The guidelines are about your investment process. So it's about your, going to how you apply that to your investment process. It is not ever a bad thing for you as a good corporate citizen, as a manager or a firm here, to adopt better ESG standards for your own internal consumption. And I think, we always encourage people to do that as well, because, we're all citizens in sort of the broader corporate sense, and it's a good thing to do. But the guidelines are very much about your investment. That then goes into the legal and regulatory consequences. If stakeholders are not keen on complying with ESG, what are the penalties? We just split that up in two ways. Firstly, if it is in the asset management universe, there are sections of the asset management universe that explain away why ESG is not relevant to them, but it needs to be substantiated. You need to say, this particular investment portfolio or thesis, the way that we set this fund up was never built on ESG principles. And we can't now suddenly convert it to having an ESG overlay, because we won't be achieving the same returns that we did. We can set up a new product or a new portfolio that has an ESG overlay, but it will be a different product. So there is that aspect of it. But I think, Joseph, on just generally, if you're a bank or an insurer and you decide you don't want to comply, that's a slightly different issue.
Yeah. So on the point about whether MAS is trying to regulate or investment risk, ESG risk or environmental risk, I think you need to sort of split the two up. As I mentioned in my when I was talking about the MAS Green Finance Action Plan, there's the risk part, and right now the focus is very much on environmental risk and not ESG risk, i.e. social and governance isn't sort of featuring in that guidance. It's environmental risk. But when it comes to promoting that green finance market, then it is ESG, and in particular the E and the S, including S, the social bit. And so there are social bonds, there are sustainability bonds, and so on. And government wants to promote that market. So that's the growth opportunity versus the risk bit, which is focused on environmental risk. When you talk about consequences, I shared with you some of the thinking of the NGFS, looking at possible actions central banks can take. So these are certainly, most of them are within the central bankers' sort of regulatory power to take. It's a question of whether they are prepared to take it. And I suspect this because there's going to be time given for everybody to put this in place. But the longer you wait, then you sort of get yourself exposed to higher transition risk, meaning to say regulators will at some point take firmer and firmer action, because remember, the risk that you expose yourself to is not just about you, it's about the risk to the entire financial system. So the central banker, MAS, has a legitimate interest to make sure that it's not just about you, the FI, it's about the stability of the financial system as a whole.
Yeah. And I think in relation to you, if you are the recipient of investment, so if you are somebody who is, if you're a fund manager, for example, or indeed a listed company, and investors are bringing money to you, they can impact you. They can say, we're not going to allocate to you because you don't have these policies in place. So there's a second question that sort of came in first, but I just want to go to this one about, are there any specific audit requirements which the MAS expects? It's challenging when each FI has to have their own methodologies, strategies, and governance structures. I think that is sort of the point. The MAS wants this to be crafted to what you do. They want you to this to be very personal to what you believe and what you do and how you address the ESG questions. Certain firms may have less, if you look at, it's not evenly weighted, it's not 30-30-30. Maybe for some firms, emphasis on governance is more important. Some firms, maybe it's in the environmental risk side of things. So I think they're expecting to see variations in it.
Yeah. So, so if you look at the guidance and you look at NGFS and you look at the guidances from the other jurisdictions, there is actually a strong expectation that you are going to integrate your environmental risk management into the rest of your enterprise risk management processes. So you're going to have that 3 lines of defense. You have the people at the business side doing the first cut of identification assessment, escalating it if it's high risk, and then the risk management people looking at whether the risk are being the sort of risk management policies are being complied with, and lastly you have the audit function that audit the risk for your entire enterprise, looking at the environmental risk as part of their function. So the idea is not to have a standalone environmental risk management. It's going to, you're going to have to sort of integrate this into your credit risk, your operational risk, and all the other risks that you already manage as part of your ongoing business.
Exactly.
Yeah.
So someone else has said, and these two sort of relate together, that the requirements are very broad-based and span across the end-to-end life cycle of governance, from product due diligence, selling processes, internal controls, supervisory oversight. How can companies quickly scale up to meet these expectations and being able to demonstrate compliance to these regulatory obligations? And somebody else has asked about, are you going to have to demonstrate internal controls in the ESG risk of selling by licensed professionals? So this is sort of about how do you actually, demonstrate the process you've got in place. Now, there's varying answers. In some of it, it's easier. It's sort of relatively easy to incorporate ESG protocols into things like product due diligence and setting up new products, establishing new business lines. There's a variety of different metrics that can be adopted. There is data that can be found. You can take more matters into consideration. When you're getting to things like the selling process and what should your licensed professionals be saying, and how are you oversighting that, it's a little bit more complicated. You're going to definitely need to have a good internal statement of purpose, a good internal communication system, a good internal training around it. They're going to need to be provided with suitably self-explanatory materials that they both can understand and acknowledge, but also that they can communicate properly to your potential customers that you're dealing with. So there's going to be lots of different sorts of people involved with this process. It's not just a segregated ESG department that sits somewhere. It's going to need to be throughout the entire organization. Joseph, I don't know if you've got some views on that.
Yeah, just a minor point that the expectations, there's a lot of disclosure involved. So, and there's also a requirement for documentation of all of your deliberations and your assessments. All these things need to be documented, and some of it has to be disclosed. So I think certainly if you think of it like that, then yes, it is a form of demonstration that you are actually complying. If you have to document your processes and disclose some of them, yeah.
Yeah, I think training is going to be really keen to this as well. You're going to have to make sure that your frontline staff understand what this is about and know what they're talking about. I can't stress that enough. Is there a good resource where we can find the most commonly used disclosed ESG metrics for corporate, or possibly a few companies have model ESG policies? There's data out there. I mean, a lot of the big service providers, the MSCI, Bloomberg, various subscription-based services, some of the big four, S&P. So, if you're investing, there's certain subsets. So, for example, you can find the S&P ESG index. So you don't have to just take the S&P 500. You can take the S&P ESG. Many of these you have to spend money on. So it is one of those unfortunate things that big commercial service providers are collecting this data, and it's hard for them to do the calculations and to repackage it, and they do charge you for it. So I think what you see is a bit of a dilemma between people saying, well, is ESG such an important part of my strategy that I purchase the services? So for those people already in the ESG universe, they definitely do that. For new people, I think we're seeing some pushback. People sort of want to be able to collate the information in a more cost-effective way, but it's a little tricky.
Yeah, I think if you're talking about each FI has its own material risk and so on. And so if you are getting data, it's very important to look at the underlying methodology. Sometimes the data may not be material relevant to you because of the way it is arrived at or derived. So just need to be aware that not all the available data is necessarily relevant to you. So I don't have a better answer than that. Yeah.
Exactly. Someone's asked about, how do you engage if you're not a large investor into individual sovereigns? But I think that applies more broadly across the board. Engagement is trickier when you have a lower AUM. The impact that you have will be smaller. And certainly in some countries, I know there's been a lot of feedback in Hong Kong, for example, where there was a proposal that everybody who was over a certain size of AUM had to be fully reporting on climate risk, which many of the industry in Hong Kong pushed back on. I think that, you may not have the ability to engage directly because you don't represent a significant stakeholder, but you've certainly got the ability to look at screening opportunities and be looking at both sort of negative and positive screening and implementing that into your investment universe, even at a relatively small size.
Yeah, and to add on to that, the guidance also talks about collaboration. So if you're smaller in size, figure out ways that you can work together with other asset managers and then engage with the investees and so on. So collaboration is one of the tools available to you.
Yeah. And I think you see that a bit in the co-investor space, Joseph, where in the private equity world, where a lot of people are taking a smaller slice of a deal, but they're working together to achieve a positive outcome. Perhaps a question a bit more for you, Joseph, about harmonization of global ESG standards. Where do we think Singapore's ESG standards and laws will be modeled after most closely?
I suspect that the leading standards are now sort of coming out of the EU, the UK, maybe in time the US. But I think from what I'm hearing from the speeches coming out of MAS and looking at the Green Finance Industry Task Force, I think they're looking at coming up with their own sort of Southeast Asia relevant standards. So I don't think they're going to follow the US and the UK sort of standards. Having said that, the Southeast Asia itself hasn't sort of come up with a lot of standards, but just last week, the ASEAN finance ministers announced the setting up of an ASEAN taxonomy board. And I'm not sure how this is going to interact or interface with the Green Finance Industry Task Force ongoing attempt to write or to work on a taxonomy for the Singapore-based, but for the region. And then now you have the ASEAN taxonomy board made up of representatives from the central bankers from, I think, 7 or 8 of the ASEAN members. So I'm not sure how these two bodies are going to sort of work together, but the announcement is it's going to complement what Singapore is doing. Malaysia has its own taxonomy already also in play, but the ASEAN taxonomy board is something to watch because I think they're going to try and harmonize something across region that is I suppose relevant or compatible with the problem with ASEAN is every time they work together to do something, it ends up being the lowest common denominator, and that's a bit scary. I think Singapore can do better than sort of the last member or the slowest member of the ASEAN member states. So that's quite something to look out for.
It is, and you know, reflects ASEAN. Obviously, it's, you know, there's many different levels of development, so it is problematic if it goes to the lowest level. From past experience, this is a good question. There's always the, you know, problem of how much is enough, and what are you going to do with disclosures in jurisdictions that are more prescriptive, like Hong Kong, and those where regulators tend to publish circulars more regularly. Yeah, it's interesting. I mean, I think if you are operating in a global organization, there will be, I think there will be areas of potentially non-compliant. So the Hong Kong consultation is very controversial. There's been an awful lot of feedback to it from all parts of the industry, bearing in mind, of course, this is not integrated regulators. So this doesn't apply to the banks in Hong Kong, nor the insurers. So the Hong Kong Monetary Authority has its own set of slightly more principles-based regulations around this, and are also running a green finance initiative similar to the MAS's, and the Insurance Authority is separate. So in Hong Kong, the SFC has gone very much on an independent path. There has been a lot of pushback on the prescriptive nature of the reporting. There's fingers crossed that it won't come out in that format, except at the most large types of firms that are already doing this on a global standard. So I think you're going to have a couple of years where there's going to be differences in and the way things are done, and just sort of over time, more stuff is going to filter to the top. Bearing in mind, as I said, that if that's an asset management type of description, I think we'll see a number of Asian asset managers who explain rather than comply, just because of the nature of their investments.
I think, yeah, let's start with the more material risks first, and work your way down. But at some point, the benefit of getting more data and more disclosure is going to, you know, be smaller than the cost of getting that data and doing enough sort of data to make a disclosure. So start with that. What is the material, the stuff that's important to your business, and I suppose relatively easier to get data on, and then work your way from there. It's not going to be 100% because at some point the costs just don't justify the materiality.
Yeah, agreed. How can you run scenario analysis not just on current but historical ESG data? And has there been examples of this, sort of specific ESG risks that have been used in modelling? Yeah, I mean, I'm certainly aware of clients who've run ESG for a long time, who have been able to model certain types of scenario analysis. Certainly on the governance side, for example, the impact of poor governance in certain countries and on certain companies has definitely led to negative outcomes. And there's been there's sort of a lot of work that's been done around corruption, for example, and, you know, the impact of corruption on investment returns, and, you know, the cost of doing business if you get caught in a corruption scandal as a bank or a lender or somebody in another country. On the environmental side, I'm sure there has been kind of black swan style modelling around some of the biggest environmental disasters that we've seen. But Joseph, have you seen that in play as well?
So the idea of the scenario analysis is actually not to look at past data. It's actually to look at future scenarios. And I think the problem, as you pointed out, is it's a lot of guesswork, but it's educated guesswork. And if you look at there are a lot of big picture scenarios. Problem is finding one or building one that is relevant to your own sort of scope operations and in geographical location and so on. What the guidance, NGFS guidance talks about is at least the 3 scenarios, which is that 2-degree world or 1.5-degree world. Imagine if the world were to be 2 degrees or well below 2 degrees or 1.5 degrees in 2050, what needs to happen for that to take place? What needs to take place for that to happen? And then sort of where will your business be sort of on the way to that 2050 scenario? The other scenario is business as usual, hothouse world. We have 3 degrees, 4 degrees world. What kind of climate events, what kind of droughts, etc. are you going to look at? How how is your business going to be operating in that situation, and then you work from there. And then the last one is that transition, orderly transition, where you don't quite hit the hothouse business as usual, but you don't hit the 2 degrees and everybody starts exiting fossil fuels industry. So you need that minimum 2, but then the third one is, as I said, is the sort of orderly transition out of carbon and fossil fuels. So these are the kind of 3 scenarios the NGFS has sort of suggested. They're big sort of broad kind of brush strokes on data. Not necessarily sort of, you need to sort of build your own, get consultants to help you build the scenarios that are relevant to your sort of situation.
Exactly. And then we have a question here about, as FIs are answerable to investors, and if you have investors with no view on ESG, the fiduciary duty is to make the investor, how is your, compromising your fiduciary duty by abiding by ESG guidelines that might potentially impact upon performance or restrict what the FI can do. It's a very interesting question. And actually, I was looking at this the other day because in Europe, in Sweden, and I believe in France as well, the governments are actually changing the laws to specifically state that ESG considerations have to be considered. You can't use the fiduciary duty excuse, if you like, to say, I don't have to do this because I won't achieve the best possible return. It's like the theoretical arguments you have around SIN portfolios, where you take everything that you take out of a negatively screened portfolio and throw it into another performance, investment performance, and see what's happened. It's something that's been looked at, so there were studies done out of California if CalPERS decided not to invest into tobacco stocks because they wanted to improve the public health outcomes. Yes, it had an impact on the performance of the employee's retirement. If you're a 55-year-old who's going to retire in 10 years' time, you're probably upset about that. If you're a 20-year-old just joining the pension fund who likes the public health outcome, that there's going to be less death by lung cancer and your health systems aren't going to be as expensive, then you have a different view. So the fiduciary duty question is interesting. It's still being debated. And there's different conclusions being reached in different countries depending on their underlying case law and underlying legal systems.
So I'm glad you asked the fiduciary duty question, because next week, 14th of April, there's going to be a launch of a legal opinion on directors' fiduciary duties to consider climate change risks in Singapore. So I'm one of the authors of that opinion, but it's actually headed by a senior counsel. And the opinion actually says that directors currently, based on Singapore law, have fiduciary duty to consider climate change risk because of their duty to the company. I think it's undeniable that climate change risk is going to impact the value of your company one way or another. Very, very few companies are going to say it's got nothing to do with us. We can carry on as we are. So if that is the scenario, then as a director, you have to consider it. And if you decide, having considered it, that it has nothing to do with you, then document it accordingly and say, well, we've considered it. It has no impact on our investments. It has no impact on our businesses. But I would hesitate to make that conclusion if you haven't consulted, you haven't sort of acquired sufficient expertise to make that decision.
Yeah, and I think there's one last question, Joseph, about the point you were sort of discussing before about specific environmental risks and scenario analysis. Sea level rises in the Paris agreements, 3 different temperature scenarios.
So just specific, sorry, I'm not sure how. Wait, let me see. You have to base it on various specific risks. I think, okay, the scenario analysis, again, based on NGFS sort of guidance, is you can do it based on trigger events to say what happens if, and then you have that if the sea level rises by a certain amount. So that's the trigger event kind of approach. The other one is do by a temperature scenario analysis, where you say what happens in the 3-degree world, what happens in the 2-degree world, what happens in the 4-degree world, and then you make assumptions about what the physical conditions are going to be like. In a 2-degree world, it means that we would have effectively moved out of a carbon economy. We would have done this. We would already have solar. We would be getting so much power and so on out of solar. And then where is your business placed in this sort of economy? So that's the temperature-based scenario analysis. And then you have that event, trigger event based, if there is a flood, if there is a this, and if there is a that. So there are different approaches.
Okay, thank you so much, Philippa and Joseph, for your wonderful insights. With that, we have now come to the end of this afternoon session. Thank you once again for joining us. Do stay connected with us on our social media platforms or drop us an email. And we hope to see you at our next webinar. Thank you once again, and I wish you a good afternoon ahead.